This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. Over the past several months, interest rates in the U.S. have remained at elevated levels as the Federal Reserve continues its effort to bring inflation under control. After a series of aggressive rate hikes earlier, the trend shifted into a holding pattern, with markets watching closely for signs of the first rate cut. Expectations have moved back and forth depending on inflation and job data. This week, the biggest development wasn't a rate change itself, but the signals around what comes next. Recent comments from policymakers and fresh economic data suggest that the Federal Reserve is not in a rush to cut rates just yet. While inflation has eased somewhat, it hasn't fallen consistently enough to justify a clear pivot. At the same time, financial markets adjusted expectations slightly, pushing potential rate cuts further out into the year. Treasury yields showed modest movement, reflecting uncertainty about how long rates will stay at current levels. So what's the real trend right now? Interest rates are steady, but with a cautious outlook. The overall direction still points toward eventual cuts, but the timing keeps getting delayed. This creates a higher-for-longer environment, where borrowing costs stay elevated even as inflation gradually cools. This week reinforces that trend. The Federal Reserve appears to be waiting for stronger confirmation that inflation is under control before making any major moves. It's not tightening further, but it's also not easing yet. So how does this hit your money? For borrowers, this means loan costs remain high. Mortgage rates are still elevated, making home buying more expensive. Credit card interest and auto loans continue to carry higher costs than many households are used to. On the other hand, savers are still benefiting. High-yield savings accounts and short-term deposits continue offering relatively strong returns compared to previous years. This is one of those moments where the gap between borrowers and savers is very clear. Depending on which side you're on, the impact feels very different. Looking ahead to next week, markets will be watching closely for new inflation readings and any additional signals from Federal Reserve officials. Even small shifts in tone or data could quickly change expectations around when rate cuts might begin. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with the updates that matter. Until then, stay informed and protect your wallet.